It's time for the Property Podcast, where every week tens of thousands of property investors, new and experienced, join together to get news, knowledge and laughs at our expense. With me, Rob Bence.
And me, Rob Dix. Join us every Thursday morning for your weekly dose of property ideas and motivation. Then head over to our website at thepropertypodcast.com to keep the conversation going. Now though, let's get started.
Hello and welcome to the Property Podcast. It is episode 110. I'm Rob B. With me, as always, is Rob D. Start spreading the news, Rob, because you've left the UK.
Very good. Yes, I have indeed. I am in New York this week and for the next few weeks. It's my wife's favourite place in the world. So we are here in the city that doesn't sleep, and I am taking that literally by recording a podcast in the middle of the night. So if I go quiet at any point, just give me a nudge somehow.
The thing is, when you said, I'm in New York, I can imagine, because when you first arrived and you said it, the amount of people who go, oh, that bloody Rob Dix gets to go everywhere, doesn't he? But everyone, remember, he's recording this in the middle of the night, so it's all evened out.
It's true.
No, but seriously, Rob, it's going to be a fantastic experience. But it's not your first time you've stayed there for a while, is it?
No, it's not. We were here for 6 months a few years ago now. So it's really nice to be back and go back to some old haunts and see what's changed. And yeah, having to do a couple of all-nighters every week is a small price to pay, really. And I'm always happy to get out of bed for the Property Podcast. This week, we are talking about the 5 questions we get asked the most answered. So we get asked a lot over email, in person, and so on. And we've picked the top 5 questions to answer in this show. And as ever, we've got a news story and a super handy resource for you via the Property Hub.
We have, but before we get started, let's bring you a news story. Now, there are plenty of top 10s in property. And normally, people want to be in that list. But this is a top 10 property list that you probably don't want to be noted in. And it's top 10 Britain's unhealthiest high streets ranked. And number 1, Rob, if you want to make sure if you don't care about your health and you want to get unhealthy, if that is your goal, then the place to be is Preston.
Yeah, it is. So Preston is topping the ranks of unhealthiest high street. Also in there, let's name check a few other places just to make some more enemies. Middlesbrough's at number 2. This isn't our survey, by the way. Northampton's in there, Eastbourne's in there. Unhealthy, apparently, is based on the presence of businesses that have a negative public impact, such as bookmakers, loan shops, tanning salons and fast food outlets, apparently. But there is good news as well. There is a more positive top 10. And number 1, the healthiest high street, according to this survey, it's one that I wish it wasn't number 1 because I don't know how to say it. Is it Shrewsbury? Shrewsbury? I'm never sure, but that's number 1 anyway.
I've always called it Shrewsbury, but maybe that's just from where I am in the world and that's how we call it. But I say grass and people say grass. And so, anyway, so number 1, Shrewsbury. And number 2, Ayr in Scotland. And actually, Scotland tends to get a little bit of a stick for how unhealthy it is, particularly Glasgow, but it didn't make it into the top 10 in Scotland. And number 2 was Ayr. So, well done, Scotland. Obviously, they've got their act together, or it was just bad PR in the first place.
Yeah, exactly. But it's the Midlands that needs to get its act together by looking at this map, with the exception of Shrewsbury. But yeah, this is one of the factors that will play into property investment, of course. Not sure quite how much attention to pay to it, but it's kind of interesting all the same. You can go and look at the top 10s and see if your local area is one of the best or the worst. The link to that story on the BBC website is going to be in our show notes this week. And this week you'll find those at thepropertyhub.net/most-asked. Okay, on now to our topic of the week, the 5 questions we get asked the most answered. So as I said, we get asked a lot of questions by various mediums. Rob B, I'm sure you get asked more than I do because you're having meetings with investors every day, but I get loads coming in by email. We see them on the Property Hub and so on. And what we've done for this episode is we've collated the 5 most common. So we were chatting about this before, and the most common ones between us seem to be pretty much the same. So across everyone we've spoken to collectively, these are the most common questions, and we're going to do our best to answer them. And we're going to do our best to give an actual answer rather than just saying it depends. But the truth is, it often does depend, and people often are wanting some kind of black and white answer when there isn't one. But we're going to do our best to make it as black and white for you as we can. So, Rob, how about you kick us off with the first, not in no particular order, but the first question we get asked the most?
Yeah, so one of the ways I get questions into me at an early stage is when people sign up to the RMP website, one of the first emails they get is, what's your biggest challenge? So for this episode, I went back through that list and looked at what people were asking me, what the challenges were, what type of questions they had. And you're right, when we discussed it before, they were all the same. And number one, and it's amazing how much this one comes up, is how do I find a deal that's below market value? I've been looking in my area and it's particularly hard. Questions around that theme come in all the time. And it is hard. That's the first thing to say. I apologise, and I'm sure, Rob, you extend that apology, if we've ever made it seem simple. It's not. It is hard work. If it was easy, we'd all do it. The dream of just walking in a estate agent, got any deals? Oh yeah, I've got this one, 10% below the normal price. Fantastic, I'll take one. It doesn't happen. Unfortunately, it is hard, but that's to be expected. Because if you get a genuine below market value property and say it's 10, 15% below the real value, and that's key that you make sure it is the real value. But if it's 10 to 15% below the real value, then that's potentially worth thousands of pounds to you. It's hard for a reason. But how do you do it? Well, what I would say is we've done podcasts on this subject and we put together a course on the Property Hub, which you can go to. So if you look at the courses section, it's free. And we talk about how to find one, what to look out for, what it is and what it isn't. The chances are, though, if you are restricting yourself to a very small geographical area, which most people do when they start, you will find it really hard to find below market value property. Because every day I see investment deals, every single day, without fail. You know, the volume I get now is increasing all the time as our reputation grows. I'm from Liverpool, but I've lived most of my life on the Wirral. In 4+ years of running RMP, I've just seen my second deal on the Wirral. Just in the last few weeks. It might not happen, but the point being is, if I just said, right, because I've lived most of my life on the Wirral, that's the only place I want to do deals. In 4+ years of running a property investment company, not just doing it part-time, I only would have seen 2. And that's the challenge that you have if you restrict your area. So what you're better off doing is casting that net a little bit further. It's not saying, do everywhere, but certainly, spread it out. If you live in the Midlands, then there's loads of cities and towns around you. Same in most places in the country, unless you live in the southwest. But most places, you have multiple cities within a close proximity. Spread that net and start to be more open to different areas. And if you're uncomfortable with certain areas because you don't know them well, then just start researching. There is no magic answer to this. It is hard work, but one of the things you'll find is if you do restrict your areas on where you're looking, you will find it exceptionally hard. I would, and I do it full time.
And I think that the thing that seems to have come up every time that someone asks me a variation of this is they'll always say, oh, it's really hard in my area. And regardless of where they're from, they'll say that it's hard in their area. But I think it is just hard everywhere, like you say, Rob. It's not like there's some part of the country that's absolutely swimming in opportunity. There will be some that are better than others. But it's hard wherever you're looking. And yeah, you're right. But by kind of looking a little bit further afield, you will be able to boost your chances because they are out there, but it's not easy to find. And I think one of the insights that I took away from an interview I did when I was writing Beyond the Bricks was that if you're always looking for the perfect deal, then you're going to spend years looking and you would have been better off taking the pretty good deal that was there 2 years ago, because by which time you would have had 2 years of rental income and capital growth. So by all means, look for the below market value deals. They are out there, but I wouldn't get too hung up on finding the absolute perfect deal.
Completely agree, Rob. So what's number 2?
So number 2 is a question which I get asked all the time. What is a good return for a buy-to-let investment? And this is a question that I really don't like getting because I always struggle to answer it, but I completely understand why people ask the question. Because if you're looking at making an investment, I've just said, don't look for the perfect deal. But okay, so what's a good deal then? What can I look at? What's a standard set of numbers for making an investment? Well, for me, return on investment is the absolute key number. So if you don't know what that is, this is the net rent after all your costs have been deducted. So you take the rent that's come in, you take off the cost of your mortgage, of management, of voids, of everything else, divide that by the cash that you leave in the deal. That is your ROI. Personally, I would look for at least 10%. Other people would probably go lower. In reality, everything in my portfolio is a fair bit higher than that, but I sort of would always say that 10% is a fair benchmark. But the trouble with answering this question is that there are so many other factors and everyone is going to have a different answer. So I throw out a number, but then loads of people are going to completely disagree with me, say it should be higher or lower, and they're going to throw in lots of other factors, and they're all correct because there is no absolute set in stone answer. And even if you've got an ROI number that you're shooting for, then there are going to be occasions where it's worth compromising on that. So, for example, if an opportunity comes up where there's a particularly high likelihood of capital growth, you might be willing to take a hit on the ROI. Or if there's a particularly easy hold, it's going to be really hands-off for you, so not much work. Or if there is future potential to the property. So it's not quite so great now, but there's potential in the future to extend it or convert it, and so on. There are loads of reasons why you might want to break your own rule. But that's a benchmark for you. I've tried to give you some kind of an answer. Another thing which I think is worth paying attention to is your absolute return. So the actual amount of money that you end up with in profit each month. Because you'll often find that especially if you're adding value and then refinancing a property, your ROI on paper could be huge, but if the rents are relatively low, then you could only be making 50 quid a month. And personally, I'd always be looking to make at least a couple of £100 a month, both because I want to actually be rewarded for all the effort I'm putting in, and because I want to be cash flow positive even at a higher interest rate. So if I'm only making £50 a month and then my mortgage goes up by a couple of percent, I could be making a loss. So there are a couple of figures for you. ROI 10% and at least a couple of £100 a month in positive cash flow. But Rob, you may have a different answer, and I'm sure everyone will have a different answer as well.
That's right, Rob. It's really difficult to say a number because there's so many factors. I think ROI is definitely the calculation to use, so in complete agreement there. I've personally accepted less than 10% for some of the criteria you explained. So I've got a property in Chester, for example, and Chester's an affluent city. This is right next to the hospital, so high tenant demand, fundamentals exceptionally strong, and Chester capital growth-wise, you'd expect it to do very well. So for the fact that it should have strong tenant demand and I expect capital growth in that area, I was willing to accept a little bit less. So it does vary, but you've pointed that out. You know, if there's different factors involved, you might accept a bit less. And then also the other confusing thing is people use all different calculations within that ROI. So some people include different things, strip things out, put more things in. So some people include insurance, some people don't. So people go to me, oh, my ROI is 14%. And then when I explain how I put my figures together, their ROI comes down to 7, 8. So it's what costs you include will have a big factor on that too. You're right, it's hard to ever answer that, but what you've given is a really good rough guide. Okay, and this is another question that comes in, which is very, very hard to answer. It's probably actually the hardest one to answer, and it's probably the one I get put to me most. And it goes something on the lines of this. I have X amount to invest, but I'm not sure what to do next. What should I do? And that is nearly impossible to know, especially if I know very little about you. You know, often people do take the time when they reply to that email that I send out. They'll give me a background, but even still, it's not enough. You know, a few paragraphs on your current situation certainly helps more than having no information, but you've really got to dig deep, and it's irresponsible for people to go, all right, actually, you should do this and invest in that. Well, why? Because if someone's telling you that might be right for them, but it might not be right for you. It's not that they're being untoward or being dodgy. It's just that that's their experience. But your circumstances are highly unlikely to be identical to the person you're speaking to. So you've got to look at your situation and really build a strategy. And that's what I'd say, and that's what my answer is. If you have so much to invest and you're not sure what to do, first set your goal. Have a clear, defined goal. We call them SMART goals. Again, we've got courses on this on the hub, and we've done podcasts on this. So you've got loads and loads to go at. But set clear, defined goals, SMART goals, and then build a strategy around it. And that's one of the things that I always do. I will never ever have anyone work with us until we've built a strategy out, because otherwise we'd fall into that trap and going, oh, look, here's a good investment, but how do we know it's right for them? So you've got to absolutely, in my opinion, set strong, clear, defined goals and then build a strategy towards hitting them. And then you can follow that path, follow that course, follow that strategy, and not get distracted by other wonderful and shiny investment deals that look good but aren't right for you. So that's what you should do. The answer should not be go and invest in this area or go and do this type of deal. It should actually be set goals, build a strategy, and then that will tell you what to do.
Yeah, you're absolutely right. It's not the most satisfying answer. It's kind of much like the previous one, where it's like, what makes a good deal? Well, it depends. I was trying really hard not to say it depends, but it does. And it's exactly the same again. It'd be nice to be able to say, oh, yeah, well, that's easy. You should take all that money and do this, this. But often the people giving you those kind of answers are people who've got some kind of vested interest in you doing that particular thing. Or even if they haven't, it's just what worked for them, and therefore they're really enthusiastic about it and they want to help out and they think everyone should do the same thing. But obviously not everyone should do the same thing. But you're right, by having that long-term goal, by knowing what it is that you're trying to achieve, then it's just a case of working back from there. And it still doesn't make it easy, but it's a lot easier when you know where it is you're ultimately trying to end up. Okay, number 4. Should I form a company to buy properties through? So this is a question which comes up all the time, and we're seeing a lot of these reflected in the Property Hub as well. So a few threads in the Property Hub from people saying, I've got this much to invest, what do I do? Also quite a few threads from people saying, should I buy properties through a company? And I was really surprised by how often this came up, because quite honestly, when I was starting out, it just is not something that crossed my mind. But it's probably a good thing that it's being asked, because it means that people are doing their research and getting a bit more educated about it than I was. So should you? Well, let's look at situations where you might want to. Well, if you're a higher rate taxpayer, then it might be beneficial. Because if you are buying properties through a company, then the rental profits that you make will be taxed as corporation tax, which obviously can change at any time, but is around about 20%, instead of income tax, which is around about 40%. But then again, if you're actively acquiring properties, you might not be making taxable profits for a while anyway. So again, in the Property Hub, another free course, we've got Buy to Let Tax Basics with Ian Wallace. Great course in there. If you're following the advice in that, you might manage to keep your profits at bay anyway. But if you are a higher rate taxpayer, that's often the situation in which people start thinking about using a company, because they don't like the idea of giving 40% of their profits away. If you are planning on holding the properties forever and passing them on to your family, then having a company there really helps as well. Because it's not entirely straightforward, it's not as easy as just having them owned by a company. There are other things you need to do as well, but it does mean that you can potentially pass those properties on without taking a big hit in capital gains tax. However, if you are looking at selling a property, then capital gains tax can be a negative in terms of having a company, because if you sell a property and you make a capital gain, then companies don't have a personal allowance, whereas individuals do, which is £10,000 or so. So that's a few of the positives and negatives. The real negative for most people, which I think doesn't get considered a lot of the time, is the lending aspect. So some people say that it's not all that hard to get a mortgage as a limited company, but it's undoubtedly more restricted than if you're buying in your own name. You're going to have a smaller choice of lenders, which means that the rates won't be as good normally, and it's just going to be a lot more work, a lot more expense. It's really lending that I think is the big negative when it comes to forming a company. But should you do it all the same? Well, if you're going to be holding properties forever and passing them on, if that's a really important part of your strategy, and if you're willing to navigate the complications of the lending side, then maybe it is. And it is something that is worth thinking about at the start, because it's a lot cheaper and easier to buy a property in the correct structure in the first place than it is to try and fix it later. So if you buy a property in your own name and then in 10 years' time you try and transfer it into a company, there are going to be capital gains tax issues, there are going to be stamp duty issues. So it's definitely worth thinking about it and going, okay, I really want to be holding these properties for a long time, passing them on to the kids is my primary reason for doing this, therefore it might be worth looking into having a company. However, I would say don't let the decision delay you from actually getting started. There are a lot of people who want to have every box ticked at the outset, and I think that this is one where people can get hung up on it, whereas in fact it's not all that important. And you know, if you get your first couple of properties and they're in your own name, and then in the future you think, oh, maybe they should have been in a company, it's not the end of the world. Things can always be sorted out. So if you're a bit further down the line, it's something you might want to be thinking about. But if you're just getting started, by all means, think about it if you think this is going to be an important factor for you, but don't let it slow you down.
Is this podcast free, Rob? Is it free?
Of course it's free.
It is, isn't it?
Of course it is.
Unbelievable. The amount of... That was a brilliant answer. Just people would charge for an answer like that. That's awesome. So I'm going to just take that clip of the podcast, and next time I get asked it, I'm just going to go, listen to this. Listen to what Rob says. That's brilliant. We're actually going to do a podcast on tax in a few weeks as well, where we'll give you even more. But outstanding, Rob. I'm not going to add anything to that because that was brilliant. Now, next one, and finally... Can you recommend a good ... We get this a lot. And in fact, in the past, we've said email us if you need a good whatever, solicitor, mortgage broker. Accountant's actually really hard to find, and it's not always worthwhile for people. So let me explain, and I'll go into more detail on the other two as well. Accountants, you have to be earning a certain amount for an accountant to be cost effective. Lots of people tend to want accountants and go looking for accountants when they've done nothing, and they only intend to do maybe 1 or 2 properties. The chances are that you probably won't need their services, and some basic tax advice will be enough. Ian Wallace, who we've mentioned before, has a book on tax. It's very good. It is about tax, so just remember that. I'm not saying it's going to be the most entertaining read, but for a tax read, it's really good. Go and read it. If you're just doing a handful of properties, that's probably enough. But if you do need a tax advisor and you've got your own business, just use your current accountant. That's what Rob and I do. Property specialists, unless you really scale your portfolio up, become effective then, but only if you're building your portfolio up to a decent size. Now, I'm actually meeting Ian Wallace in a few weeks, which will inspire that podcast I've just mentioned. So, accountants, yes, fair enough if you're building a big portfolio, but don't worry about it if your portfolio is going to be modest. Mortgage brokers and solicitors, that's a different kettle of fish altogether. You need them. Okay, a solicitor you definitely need, and you can't get around that, but a mortgage broker is always worth doing. And I've worked with several. I'm not partisan to one. It's like, you must use this one person. I've given recommendations out on different brokers and just people I've had experience with or I've heard good things about. And if you email either of us, we're more than happy to do that. Solicitors, I'd say 90% of them I've dealt with have been awful. And now if you're a solicitor who does conveyancing and you're listening to this, please get in touch if you are not awful, because I'd love to pass more business on to you. But really, unfortunately, it's an industry, like many in property it seems, where the standard is not very high. Although I have worked with some good solicitors and I can pass the details on if you contact us. And I don't want to throw names out right now in the podcast because they'll get inundated. But if you really do need some help and some advice and you want a recommendation, then just drop Rob or I a line and we can point you in the right direction.
Yeah, and I think you're absolutely right on the accountant point as well. That's something that I get asked all the time. It's like, often with me, it's like, I've just read your book. I'm just starting out. Can you recommend a good broker and a good accountant? And the accountant part, well, for a start, I don't really have a recommendation, but also I just think it's just not important right now for the most part. For some people it will be, but for the most part I don't think it really is. And I think there is kind of like a subset of property education where they talk about the importance of getting your power team together. And I think maybe it comes over from that, like people thinking that they need to have every base covered before you get started. And I don't necessarily think that's the case. But you're right as well that solicitors are hard to recommend. That's another one that I get asked all the time, and I just don't have a satisfying answer. But I hope we have had some satisfying answers for you in this episode. Not easy, because they're all really, really good questions, and it would be really nice to just give a cut and dried answer, but it's not always possible. But I hope that we've given you as detailed answers as we can and given you something to think about. If you want to refer back to the show notes for everything that we've talked about in this episode, they are going to be at thepropertyhub.net/mostasked.
Right, as always, it's time for our resource of the week, and this week it's a cracker. Thank you to Anthony Hubbard in the Property Hub. So the Property Hub, he was posting in there, and this is a brilliant tool. It's called Property Tracker for Chrome. That's Property Tracker for Chrome. Now, we'll link to it in the show notes, of course, which is thepropertyhub.net/mostasked. Have a look at the show notes and you'll find this link. But basically, it's a right move tool that's a bit like Property B. Now, Property B doesn't really seem to be working anymore. It hasn't been updated in a long time. Well, certainly I'm not getting it working. And that's a shame because it was a really useful tool. And people have asked, what a shame that doesn't work anymore. And this has just come about. Now, I've literally installed it in the last 24 hours. So, Rob, you've been using it for a week. How have you found it?
I found it really good. It's not as comprehensive as Property Bee. Property Bee, it is working for me at the moment, but I'm hoping that nothing changes because it just seems really janky and it gets easily thrown out of whack by different things. And sometimes there'll be a browser update and it will all go wrong. But when Property Bee is working, it will give you a nice breakdown of exactly what's changed and when it changed. So it will tell you things like if a certain way of the property description was phrased has changed, it'll pull that out for you. Property Tracker doesn't do that. All Property Tracker does is tell you about price changes. So it's not as comprehensive, but it's nice because it is so simple. All it does is next to the price of any property for sale or to let, next to the price, it just puts an arrow. And it'll either be a downward arrow indicating that there's been a price drop, an upward arrow indicating that there's been a price increase, or just showing that it stayed the same. And if you hover over that arrow, it'll tell you what the price was before and when it changed. And it is really nice because it doesn't take up a lot of space, it's not cluttered, it just tells you that one really important bit of information that's normally missing. I haven't tested it extensively, so I don't know quite how big its database is, but every search that I've done so far, it has brought up the info.
I also have to give a hat tip to Dale in our office because he did point me in the direction of this tool as well, roughly the same time as Anthony. So thank you, Dale, too. Good to see you're on the ball. Right, time for our review of the week. And this person is obviously on the ball, Rob, because they've left us a review. And it comes from Ms. Trailblazer. And it says, "Thank you very much, Rob and Rob. Thank you very much for making time out of every week to create these awesome podcasts for free." See, the free bit. "The content is top class. I can only imagine how much goes into getting them ready for us. I really also appreciate you're willing to share your knowledge for free with no strings attached. I've only recently come across the podcast and I've shared it with 3 of my friends, thank you very much, already and will continue to do so. Rob and Rob are doing a great job and making a big positive contributions to people's lives worldwide. God bless both of you. I pray you'll never lack and your will to continue and attain ever greater heights. Well done and thank you very much again." Well, Rob, we're obviously doing an all right job. Thank you, Ms. Trailblazer. That is a lovely review. I really appreciate it.
Yeah, that's fantastic. Thank you for the nice words, but thank you especially for telling your friends. And if you do have any friends who invest in property but don't listen to the show, please do tell them. It's nice for our egos to see the numbers growing, but it's also nice because it points more people towards the Property Hub. And the more people there are contributing in there, the more knowledge there is freely available for everyone to share. And podcasts are not the easiest medium to get into. When I tell people about this podcast I present, I get blank looks a lot of the time. So if you can help out a friend by letting them know that the podcast is out there, we'd really, really appreciate it. So that's us for this week. Next week, a potentially controversial episode. I don't know how closely you've been following the election debate that's been going on. It feels like we've been having election fever for years now, but it's only really been a few weeks. But there's not long to go. And so who should property investors vote for in the general election? Well, that's what we're going to be exploring next week.
Yeah, where we lose half our listeners. Yeah, week after, religion. Which one's for you? No, definitely not. Right, we'll just stick with the general election, and we'll try to keep our personal opinions out of it as well, because property has really taken centre stage as one of the core topics that the politicians all seem to be talking about. It's not, sometimes property gets pushed down the agenda, but this time property has been really talked about in depth by nearly every party. So we're going to look at that, look at their policies and assess them, which are positive and which are negative. A quick mention, just so you know, you've got literally a few days after listening to this to sign up to the magazine to make sure you get the first issue. The first issue is going out in early May. We've nearly finished. All the bits and pieces are coming in. Rob and Mish have done an amazing job, and as well as the rest of the team, Abby, and incredible. I've looked at the pictures and made comments, but the magazine, being serious now, is something we're super proud of. It is the biggest thing we've ever done. And thank you to so many, hundreds and hundreds of people have subscribed already, and that's incredible. Thank you so much. It's just so nice to see everyone get behind it. But if you want to make sure you get that first copy, then make sure you go to thepropertyhub.net/magazine and subscribe. It's only £20 a year, and that's including delivery.
Yep, so you go and do that, thepropertyhub.net/magazine. I'm going back to bed, and we'll see you back here next week for our episode about the general election. But for now, bye-bye.
Bye-bye.
Thanks for listening to the Property Podcast. Make sure you join our mailing list at thepropertypodcast.com.
And remember, we love 5-star reviews. Rob even loves them more than air miles.